Morgan Stanley just put out a warning that most people are going to miss. And if you miss it, it is going to cost you not a small amount, a meaningful amount. I have spent my whole life studying how economic machines work, watching cycles repeat themselves generation after generation. And I'm telling you, I have seen this exact pattern before. Every single time, the warning is buried in a research note most of you will never read, written in language designed for institutions, not for regular people trying to protect their savings. But underneath the jargon is a very simple message. The thing that has been holding this economy up is not what you think it is, and it is starting to crack. Businesses are still spending like it is a boom. Regular families are not. That gap does not close quietly. It closes with a shock. And by the end of this, you are going to understand exactly what that shock looks like when it tends to arrive and what you can do about it before it does. Now, before I go further, I want to say something, and I mean it. What I'm about to explain to you is the kind of thinking that took me decades and a lot of expensive mistakes to learn. Institutions pay enormous fees for access to this kind of analysis. You are getting it for free right now, because I believe understanding how the machine works should not be reserved for people with $100 million. So if that matters to you, hit subscribe before you keep watching. It costs you nothing, and it means you will not miss the next piece of this puzzle when it comes. So let's start with what was actually said, because the headline alone tells you almost everything. Morgan Stanley titled their mid-year outlook with 4 words. CapEx over consumption. 4 words. And if you understand what they mean, you understand the whole story. CapEx is short for capital expenditure. That is money companies spend building things. Factories, data centers, chips, infrastructure. Consumption is the other half of the economy. That is you and me buying groceries, paying rent, going out to eat, replacing the car when it breaks down. For most of modern economic history, consumption has been the engine. It is usually 2/3 or more of everything that gets counted as economic growth. Businesses matter, but people spending their paychecks is what keeps the lights on. What Morgan Stanley is telling their clients, quietly, carefully, in language wrapped in enough hedging to protect themselves legally, is that this is no longer true right now in this economy. It is corporate spending on artificial intelligence infrastructure that is carrying almost the entire load. The consumer, the actual person, is losing ground underneath it. Wages are not keeping pace with the cost of living the way they were a couple of years ago. Energy prices have been pushed higher by conflict overseas, and that acts like a tax on every single household. Whether you notice it or not, you still have to buy gas, you still have to heat your home. That money comes out of the same paycheck that used to go toward a night out or a new pair of shoes or saving for your kids' education. So it is not that the economy looks weak on paper. On paper, growth numbers still look fine. It is that the 2 engines pulling this economy forward are wildly out of balance, and one of them, the bigger and more important one historically, is quietly stalling. I want you to understand why this matters so much. And to do that, I need to teach you something about how economic cycles actually work. Because this is not new. This has happened again and again throughout history. And once you see the pattern, you cannot unsee it. Think of an economy like a machine with 2 gears. One gear is investment, business building for the future. The other gear is consumption, people spending in the present in a healthy expansion. Both gears turn together. Businesses build because people are buying, and people buy because they have jobs and rising wages. From all that building, it reinforces itself. Money moves in a circle, and everyone in the circle feels like things are getting better at roughly the same pace. That is what a balanced expansion actually feels like. And most people living through one do not realize how fragile that balance really is. But late in a cycle, something predictable happens almost every time. A very exciting, very real technological story arrives, and businesses start pouring money into it far faster than the actual return on that money can be proven. I have studied this pattern across centuries, not just recent decades. And the details change, but the shape never really does. We saw this with railroads in the 1800s when track was laid faster than freight demand could justify, and a huge portion of that capital was eventually wiped out, even though railroads absolutely did change the world. We saw it with the fiber optic build-out right before the dot-com crash, when companies buried far more cable in the ground than the internet of that era could possibly use. And the internet turned out to be completely real and completely transformative. It just did not save the companies that overbuilt too early. We saw it with housing right before 2008, when construction and mortgage lending became the story everyone was excited about. Credit was cheap, building was booming, and underneath all of that, household finances were quietly weakening in ways the headline numbers did not capture until it was too late. Each time, capital spending becomes the story that dominates the headlines and the stock market, while the ordinary consumer, the actual demand side of the economy, gets less attention because it is boring and it does not go up in a straight line the way an exciting new technology does. Right now, that exciting story is artificial intelligence infrastructure. So to be clear, I am not telling you the technology is fake or that it will not eventually pay off. That is a completely separate question, and probably a question with a positive answer over a long enough time horizon. What I am telling you is that the spending on it has become so large, so fast, that it is now propping up growth numbers almost by itself. And history tells us that when one gear turns much faster than the other for too long, the machine eventually has to reset the two gears back toward balance. Sometimes that reset happens gradually, quietly, almost painlessly. More often, because expectations get so stretched and so much capital gets committed based on those expectations, the reset arrives as a shock rather than a gentle correction. That is the part people forget in the middle of an exciting boom. It is never obvious in the moment that the two gears have drifted apart. It only becomes obvious afterward, when everyone wonders how they missed something that in hindsight looks so clear. So let's talk about the consumer specifically, because this is the crack beneath the surface that most people are not watching closely enough. Jobs data recently came in weak, really weak. Tens of thousands of jobs created in a month, where a healthy expansion should be producing several times that number. When job creation slows down like that, it tells you businesses are getting more cautious about hiring, which means household income growth slows down too, which means people have less room to spend on anything beyond the essentials. This is not a single bad month you can wave away. It is a signal, and signals like this tend to compound, because a business that pulls back on hiring this quarter, usually pulls back a little more next quarter too, once the caution sets in. At the same time, energy prices have jumped because of an oil supply shock tied to conflict in the Middle East, and it has been described as one of the more significant supply shocks this economy has faced in recent years, right up there with the disruptions from the pandemic and from the war in Ukraine. When oil prices climb, it does not just cost more at the pump. It raises the cost of shipping, of manufacturing, of heating your home, of nearly everything downstream, because oil is an input into almost every physical good that moves through the economy. It works like a hidden tax that falls hardest on people who were already stretched thin, because wealthier households can absorb a higher gas bill without changing a single thing about their lives, while a family living paycheck to paycheck has to cut something else out of the budget just to cover it. There is no negotiating with that kind of pressure. It shows up whether you are ready for it or not. This is why you are starting to hear the phrase K-shaped economy used more and more. And I want you to really sit with this image, because it is one of the clearest ways to understand what is actually happening beneath the surface. Picture the letter K. One line goes up and to the right. The other line goes down and to the right. Same starting point. Two completely different paths. The upper line represents households who own financial assets, who benefit when the stock market rises because of AI spending, who have savings cushions and multiple income streams. They are doing fine. In many cases, doing better than ever. The lower line represents everybody else, people whose wealth is mostly tied up in a paycheck rather than a portfolio. And that group is quietly losing ground, cutting back on discretionary purchases, leaning more heavily on credit cards just to keep up with the basics of daily life. And here is the uncomfortable truth about how economies actually work, one that gets ignored during every boom because nobody wants to hear it while the party is going. You cannot run a healthy, durable expansion off the top of the letter alone. The stock market is not the economy. Eventually, the bottom part of that K determines what happens to actual consumer spending. And consumer spending is still the largest single piece of this economy. No matter how exciting the AI story is, or how much of the stock market's total gains it is currently responsible for. Now let's go one layer deeper, because this is the part that connects everything. And it is the part I think most people are genuinely unprepared for. All of this capital spending on artificial intelligence has to be financed somehow. Companies are not just paying for these data centers and chips out of their existing cash piles anymore, the way you might imagine a wealthy, cash-rich technology company would. They are borrowing enormous amounts of money to do it, issuing corporate bonds at a pace we have not really seen before, tied to a single theme. A year ago, estimates for how much the largest technology companies would spend building this infrastructure were already considered large, hundreds of billions of dollars combined, and those estimates have since climbed sharply, well beyond what anyone projected just 12 months earlier. And they are projected to climb even further into next year. That is not company profit being reinvested quietly out of a rainy day fund. A meaningful chunk of it is now debt, sitting on balance sheets, with interest payments that have to be made regardless of whether the AI investments generate the returns everyone is currently assuming they will. And when a huge wave of new bonds hits the market all at once, from companies all chasing the same theme at the same time, basic economics kicks in. The same basic economics that governs any market where supply increases faster than demand. Investors who are being asked to buy all this new debt start demanding better terms, higher yields, because there is simply more supply of bonds competing for the same pool of buyers than there used to be. This matters to you even if you never buy a single corporate bond in your entire life, because credit markets are the plumbing underneath the entire economy. The pipes nobody sees until they burst. When credit gets more expensive or harder to access, it slows down lending everywhere, not just to the giant technology companies. It makes mortgages pricier for a family trying to buy their first home. It makes it harder for a small business owner to get a loan, to expand, or even to make payroll during a slow month, and it eventually shows up in slower hiring and slower wage growth across the whole economy, which brings us right back to the consumer weakness we just talked about a moment ago. It is a loop, and loops like this are exactly how these things tend to work. The spending that is holding growth up today is quietly building pressure in the credit markets that could weaken growth tomorrow. That is precisely the kind of dynamic that looks perfectly fine, even impressive, right up until the moment it does not. And by the time it shows up in a headline, the pressure has usually been building for a while already. There is one more piece of this that deserves your attention, and it involves the people who set interest rates, because they are the referee in all of this. And markets take their cues from the referee, whether they admit it or not. There has been a leadership change coming at the central bank, and the person stepping into that role is expected to communicate very differently than markets have gotten used to over the past several years. More cautiously, less predictably, in public at least. That might sound like a small procedural detail, the kind of thing only economists care about, but it is not small at all. Markets hate uncertainty about the referee, almost as much as they hate bad news itself, because a huge amount of asset pricing right now assumes interest rates will come down in a smooth, orderly, well-telegraphed way over the next year or two. Trillions of dollars of stock and bond valuations are quietly resting on that assumption, holding up if that assumption gets challenged. If the new leadership signals something even slightly different than what is currently priced in, whether that is being tougher on inflation than expected or simply less willing to hold the market's hand through every announcement, you can get a violent repricing across stocks, bonds, and everything in between, even if nothing about the actual underlying economy changed that particular day. That is how markets work. They do not just price in what is happening. They price in what everyone expects to happen. And when that expectation shifts, suddenly the adjustment can be sharp and fast. So you have three things stacking on top of each other. And this is the part I really want you to hold on to. A consumer quietly losing ground under an energy shock and weakening job growth. A record wave of debt financing, an AI build-out that has to eventually justify itself with real, provable returns rather than just exciting projections, and a central bank leadership transition adding a fresh layer of uncertainty right at the moment markets can least afford it. None of these three things alone would necessarily cause a crisis. Economies absorb single shocks all the time, stacked together, arriving in the same narrow window of time, reinforcing each other. That is exactly the kind of setup that has preceded real dislocations throughout economic history. I'm not telling you this to scare you for the sake of scaring you, and I have no interest in doom for its own sake. I am telling you because understanding how the machine works is how you protect yourself from it rather than being caught completely off guard by it later. So here is what I want you to actually do with this, because information without action is just anxiety. And anxiety has never once protected anybody's savings. First, understand what you own. Really look at it line by line. If you have to, if your portfolio is heavily concentrated in the companies driving this capital spending boom, you are essentially making a bet that this capex cycle keeps expanding without a consumer-driven slowdown catching up to it first. That can absolutely keep working for a while. It has before in earlier cycles, sometimes for years longer than anyone expected. But you should know that is the bet you are making deliberately and with open eyes, rather than discovering it by accident later at the worst possible moment when the discovery comes with a much smaller account balance attached to it. Second, pay attention to the signals rather than the noise, because the noise is designed to keep you watching, and the signals are usually quieter than that. Watch what happens to consumer spending data over the next couple of quarters, not the headline growth number that gets repeated on television, but the actual health of household finances underneath it. Things like credit card delinquency rates and how much of each paycheck is going toward debt payments. Watch credit spreads, meaning how much extra yield investors demand to hold corporate debt over safer government debt. When that spread widens quickly, it is usually telling you something the stock market has not fully priced in yet, because credit investors tend to smell trouble before equity investors do. And watch how the new central bank leadership actually communicates once they are fully in the seat, because the gap between what markets expect and what they actually deliver is where a great deal of the coming volatility is likely to originate. Third, and this is the principle that has mattered most across every single cycle I've studied over a very long career, have a plan for what you do before conditions change, not after. The investors and institutions who come out the other side of these transitions intact are almost never the ones who guessed the exact timing correctly, because almost nobody guesses timing correctly with any consistency. They are the ones who diversified sensibly across things that do not all move together, who did not let one exciting theme dominate their entire portfolio, no matter how good the story sounded at a dinner party, and who had already decided in advance what they would do if the environment shifted. So they were not making frightened, emotional decisions in the middle of an actual shock with everyone around them panicking at the same time. I want to leave you with a challenge, because understanding a cycle only matters if it changes what you actually do afterward. Go look at your own portfolio this week, not next month, not when things feel calmer. This week, while the picture is still fresh in your mind, ask yourself honestly how much of it is riding on this one capital spending story, continuing uninterrupted, and how much of it would genuinely hold up if the consumer side of this K-shaped economy keeps weakening the way the data is currently suggesting it might. You do not need to panic, and you do not need to sell everything and hide in cash under the mattress. That is not what disciplined, thoughtful investors do. And it rarely ends well for the people who react that way. What you actually need is clarity. And clarity comes from looking honestly at your own situation, not from hoping the story keeps going the way it has been going. I have watched too many people over the years, smart people, capable people, people who are excellent at their own jobs, avoid looking closely at their own numbers simply because they were afraid of what they might find. Do not be one of them. Fear of the number is almost always worse than the number itself. The people who protect themselves through a cycle like this one are rarely the ones with the most information available to them. They are the ones willing to act calmly on the information they already have before the crowd around them starts reacting emotionally instead. If this helped you see something more clearly today, share it with someone whose savings you actually care about, because understanding how the machine works underneath all the noise is not a secret that should belong only to the people managing billions of other people's money. It belongs to anyone trying to build something that lasts through more than just the good years.